Anyone jumping at the chance to offer a prayer?
I'll do it since I made it home safe. Our Father in heaven, we're grateful for this day and we're grateful that we could be here and meet as a group. Pray that we'll be able to understand the case and the things that we should learn from it. Pray that that would help us in our studies and increasing our education. We pray for this blessing and give thee thanks in the name of Jesus Christ. Amen.
Amen. Okay, so did everybody get a chance to read through it?
I'm on page 11.
Yeah, I got through it on the way between.
I think that's the end of the. Am I still there?
I can hear you, but it just went completely quiet.
Yeah, I can hear you.
Okay. Okay, so you want us to begin. Okay, so did anyone not read it? Is anyone not familiar with it?
I just skimmed
I can
through it.
rehash the
I
synopsis.
read the whole thing.
I'm sorry, say that again, Jordy.
I just skimmed through it. I haven't read it completely.
I ran in detail. So basically, the situation is they have done. They launched a company. They weren't quite organized, prepared, whatever. They faced some serious challenges. They came back to the drawing board. They cleaned everything up. They improved the menu. They improved the facilities. They improved all the procedures, and they started taking off. Growth was, in my opinion, pretty impressive. It looked like within about 3 years they were just adding stores after stores after stores. And basically they've gotten to this turning point where they're trying to determine should they continue growing the company by means of company financing, so just keep doing the growth themselves, or do they branch out into franchising, or do they branch out into strategic partnerships? Basically, if they're going to maintain their growth, how are they going to do it? And also trying to remember that this particular segment, this what do they call it, fast casual, is becoming more inundated with competition. One thing they want us to discuss is what people think the term fast casual means. Does anyone have a good description for that?
I was thinking fast casual, like when I was thinking of Noodles and Company, the first place that popped into my head was Panda Express. I don't know if you guys are familiar with it.
Yeah.
Very.
Very. I don't know if that's the right for fast casual, but that's what popped in mind.
My understanding was. Sorry, go ahead, Paul.
Well, I was going to say, as I was trying. Sorry, what? Oh. Well, I was going to say, my understanding of fast casual is I was actually been considering opening a restaurant. It's that in between fast food and going to an actual dining establishment like like Red Lobster or Olive Garden, where you have the long wait time. But it's getting rid of that wait time and being able to go through a line, get a freshly made meal quickly without having all the garbage ingredients associated with the fast food name, and being able to enjoy a meal relatively quickly and for a lower price.
That's pretty good synopsis. That nailed it on the head, if you ask me. Anybody want to weigh in on that? Nobody's jumping, so I guess we'll move on. So based on that particular segment, which they basically were one of the first to step into and or even create the terminology for, what problems or setbacks do you think they have in that particular segment right now?
in the segments or for this particular restaurant?
The segment itself, what's going on in the segment that could be a problem for the company?
Well, you have group.
Go ahead. I'm sorry, Paul.
Here, you can go on. You talked before me.
Okay. Well, I think from reading it, finding the right balance of serving the food quickly and getting the right atmosphere, right? Because I I also thought of Panda Express, but Panda Express is also like fast food because it's fast and quick. So I think you have to find that right balance, right, where it's fast, casual, and not necessarily. And so I think when they're creating the segment in the industry, I think they have to work really hard in creating that the right balance, the right atmosphere.
So finding a position of good, reasonable price, higher quality food, but still maintaining the faster turn times.
Yes.
I would say too, like to find their customer segment, I feel like maybe they should like I can't remember someone in the story, they went and they did all this work like by promoting the restaurant so people would get to try it. I think that's something that they could do with other of their stores because when you hear noodles and for example, uh, whenever my brother-in-law whenever he was little, we took him to Cheddar's and he started crying because he didn't want to go to Cheddar's because he thought all they sold was cheese and nothing to eat.
That sounds amazing.
I
And
know. I'm all
I'm
aboard
just
for that.
saying.
and Noodles and Company, like they might people may not really know. Maybe they sell other stuff or how good their stuff really is. So I think maybe like finding the right customer segment around the areas where they're opening the new locations would be, a lot of help for them.
Yeah. And what? One of the major, it's a, I refer to the term, growing pains, but a real situation they've got to address is there's tremendous growth in this segment. There was actually an example offered where a decade earlier, you wouldn't, if you went to go buy dinner for your
I think we lost
unit,
you.
dinner, it was about $10. I heard that. Hear me?
I can hear you now.
Norman, Jordy, Miguel, can you guys hear me?
Yes.
Yeah, but you're breaking in and out, so I don't know what's.
Yeah.
And okay, any better?
Yeah, that's better.
Okay. Sorry, I'm operating out of a motel in Monterey, so my signal's not that great. Anyway, they were offering an example that there had been such a shift in the cost of eating out versus the cost of eating at home that this particular segment has taken off, which means there's a lot more customer base to go for, but by the same token, a lot of other companies were noticing that growth in almost themselves. Anyone else see much on that ground?
Sorry, but I only heard like part of the like you are breaking off real bad.
Yeah, this is not a good
Darn
night for
it.
internet connection.
Okay.
Well, after reading the first part of the case, um, you know, he's got some problems with his restaurant. I think he has a good idea. He's getting to the right segment. There's growth opportunity. Um, but I guess he has to figure out how to finance, right? He has to figure out if he's going to franchise or if he's going to keep self-funding restaurant growth.
Right.
So, you know, I guess that I look at that as kind of a weakness, right? Because yeah, I think I read in there he borrowed up to $200,000 from friends and family. He had to sell a bunch of stock for 50,000 just to keep financing, and uh, so you know I saw those as a lot of the weaknesses that that he had at the beginning.
For me, the number one sign of a weakness is the menu, and they addressed that early on with the menu having an issue of not being up to par with what they needed. They then switched to sautéing the noodles later on, which improved the quality and stuff. But when the sales are dropping in a restaurant, the first thing to always look at is what's wrong with the food. Because if the food is good, it doesn't matter how inconveniently located you are, people are going to come.
I agree. That's one of the issues or problems that I saw. Just in there, they have limited of items.
And they had to also change their customer image with the first two stores that they had, plus the third store that already had a fairly people already had a notion of, yeah, it's cheap food, but it's not good pasta. And so now they had to spend all this time to work around that notion and get people to try out a revised menu, which it can take a long time to get customers back in the door once you've lost them.
Indeed. Hey, can anybody hear me?
Yes.
Excellent. Hey, Norman, are you back yet?
You scared him away. It's like a deer.
Apparently. Okay. I'm going to try and jump through this really quick then because I'm having a hard time keeping a signal. So outside of the company shortcomings initially, what other problems can you guys see them facing moving forward?
I think the biggest thing they've got is competing for customer dollars in a rising generation of fast casual restaurants. I mean, if you just look in my area alone, there's easily 3 burger joints. I think Smashburger, Chipotle, The Habit, countless others are rising in their wake as well, and it's just, who am I going to spend my $10 for a dinner on today? That's what it comes down to.
Yep.
Yeah, I mean, I think he has the right idea, but you know, I think it's a little bit of combination of what's his growth strategy. You know, the food needed to be better, right? I think you know when he re-engineered, you know, the dishes and the food and just you know the paint and the atmosphere, things were better. But you know, it's a combination of all those things that he really struggled with at the beginning.
With that problem or an issue currently, culture is either impacting, both limiting or helping their growth.
Well, right now, I think their current growth and culture of being self-financed is pretty good. I mean, yeah, they do have their flaws, and I think they need to work out some of their management structure for a smoother flowing operation. But overall, they're keeping steady, and they're able to self-finance themselves in a way that allows them to keep afloat. Now, if they were to go public, like in the example of Chipotle, they'd find themselves having to open restaurants, even when they may not necessarily be ready for that kind of rapid growth. And that could also come back to hurt them, just like it did Chipotle, like, what was it, 8 months ago?
Yeah. But yeah, 8 or 9 months ago.
And when you're in the fast casual segment where a lot of the food has to come in fresh, you have the higher risk for spoilage and everything, and that those are factors to consider when you have a restaurant is how quickly are you turning over your inventory.
Also, they didn't mention anything about like marketing or like for example I wonder if they like it didn't specify if they had like specials or like if they change their menus around or not, like ever so often, like have like a new item or something like that. So I'm just wondering if it's the same revised menu or you know.
Well, based on the website, it looks like they've got 12 main bowls and then salads. I think we lost people.
Yeah, I think so too. But they're. I don't know if I kind of got from it that they're great at one of their biggest threats is they're also the competition, right? I think you mentioned that, Paul. The competition they were, with other companies, right? That are also trying to break into that segment. They have to figure out the right. They have to have the right game plan, right?
And I think the other issue that they have to face is that Noodles and company seem like he had the right idea, but I think when it came to getting things organized and ready to go right off the bat, he was kind of lacking in that structure. Whereas these other fast casual restaurants that are springing up, they have a more standardized system coming in. They're able to process customers a lot faster, keep them happier, and get their return business.
Okay, what's next? We're losing everybody.
Yeah, I'm gonna pull up the agenda here real quick. Bear with me. I should have had this opened up earlier.
Can you hear me now?
Yes. Just like the Sprint
Holy
commercial.
crap. Starting to feel that way.
Oh, that's the Verizon.
Norman, are you with us? I am literally holding my laptop in the air trying to keep a signal.
Oh my goodness. Let's try to get this going through then so your arms don't die.
Okay. Am I still with you?
Yeah.
Okay. All right. I'm going to, if you guys are okay, I'm going to kind of jump through a couple sections here just so that we can get through everything we need to get through.
Yep, sounds good to me.
Okay, so let's discuss a couple things. Number one, what options do they have for growth? And can you name any pros and cons for each approach?
Well, they can franchise, and franchising, they're giving people the license to act as a restaurant in their name and utilize their recipes and everything, and that's good because now they don't have as much money invested into equipment and real estate. That's all on the other guy. But they also have a little more risk because they don't have quite as much control over that restaurant. but at the same time, that could be good because that restaurant can then change things to be a little more regional and thus favor the customers of that area more effectively.
Yeah, I think you got it right with the franchise, right? The financial risk is not a problem for them anymore, right? The investors take that, but the disadvantage is maybe having a little less control. They could self-fund. I mean, another option is they could keep doing what they're doing now, right? Is use their own money to invest in more restaurants, but I think that's a very slow way to growth, right? If their goal is rapid expansion, I think franchising is the way to go. But another option is they can keep self-funding different restaurants.
Well, if you look at their self-funding history between 2001 and 2002, their sales and number of stores skyrocketed, but their overall revenue profit was literally the same from year to year. So I kind of feel like they're able to fund it internally, but it's not yielding them a profit. It's yielding them growth, and it's not costing them, but it's not improving their bottom line. But I kind of feel like that's part of what they want.
Well, you also
they want the company. Go ahead.
I was just gonna say, part of why that revenue is not expanding is because for every store they open, how much money are they spending in real estate, kitchen equipment, initial food, training employees?
Extra
there's
managerial staff.
Yeah, there's a lot of money to fork over there.
Oh yeah,
and a lot of oversight too, right? I mean, if you're self-funding these restaurants, then you have to make sure everything is working, right? You have to go and do all the work.
Well, their revenue did double between 2001 to 2002. It went from 376,000 to 688,000.
The revenue did, but if you look at the bottom line, the net cash provided by operating activities, they netted the exact same amount of cash.
No, that's net cash. Look at Exhibit 1. Their net income doubled.
Yeah, but that's okay. I guess it did double, but let's be honest. You're dealing in a $50 million a year business, and you made $700,000. I'd say that's not an improvement.
Not very good margins.
Well, let's just figure out what that is, because it might not be that bad a margin, because that's after taxes and everything.
Well, 28 million in 2001, and then they tacked on another 22 million in 2002. First, in terms of just sales.
Are we still there? Did we lose somebody?
Yeah, so that
I'm here.
Yeah, so that's the margin.
Did catch what Norman said? Did anybody else?
No, at the end it faded out.
Yeah, I think we lost him again. Norman,
I
if
mean,
you
but
can hear us,
looking-
you look really
looking
good
at
in
the-
freeze frame.
But looking at their what do you call it? Their financial statements. I do see, the 2000 they were losing money, and then 2001 they're making money, and then 2002 they're making more money, but still on $50 million of sales. I mean, I don't, not the best margins, right?
It looks a little painful to me.
Yeah, I mean, I'm trying to see where all the money's going.
Well, they have to have
it's
4
like
managers on site.
That's a lot of managers.
Each one at
Well, let's
40,000 a year. So
am I still with you guys?
yes.
Yeah.
I can never tell. Okay. What do you guys think about strategic partnership?
Like well, what do you mean by
Here,
strategic partnership?
I'll define strategic partnership for you. It's a formal alliance between two commercial enterprises, usually formalized by one or more business contracts, but falls short from a legal partnership. So basically, another company or enterprise would come in, and between the two of them, they could finance growth.
It's kind of like a strategic alliance. It's like two. It don't even have to be a same type of company. It can be like separate companies. For example, like a like a let's say like an airline with like a rental place. They come together to serve a customer, and they both get customers and benefits off of joining together.
So do you think it's an option for them?
I think so. Their only problem would be figuring out which what type of business to join ventures with.
Then they also have the issue of a power struggle because both companies, regardless of the alliance, they're going to have their own agenda.
Oh yeah. I honestly think
Absolutely.
a franchise would be right on track of what they're really looking for is to expand, to get their name out there. But once they expand, like there's two problems that could happen. One, they could lose customers because other places aren't meeting their standards, or they could do a lot more business because they're getting their name out there and they're all putting good quality food out. But in order for them to expand as much as they want, I think a franchise would be their best option.
Yeah, a strategic partnership, is definitely an option. I'm not sure if it's the best one, but it could be a good one, right? You mentioned, maybe the power struggle or the politics of it is always a con, but if that means bringing someone, another company that has the money to finance growth and has some ideas, I think it can be a positive thing too.
Yeah, yeah. But
Seems like any option has pros and cons. It's just determining which one fits
Which one the
what
best?
you want to achieve best. What about an IPO?
Going public then, huh? I mean,
That
that's a good way to raise
Yeah.
money, I guess.
it to me it's really good because it gets them the money needed to expand, but then they have what I'm gonna refer to as earlier as Chipotle syndrome, where you have all the investors wanting you to expand as signs of good growth and revenue build up, and then you find yourself in a corner of now you've opened up too many restaurants and you can't support them all.
I mean, I guess that could happen, but they could also, if they're smart about it, if they're good business people, they could learn from that, right? So we have to find the right amount of growth and keep right where we build value for our shareholders, right? They can go about it in the right way too. I mean, it's definitely an option. Like who was that? Was it Andrew? You were saying that it's all options are on the table, but some pros and cons, but kind of depends on what the owners and shareholders want to do.
Yeah, and that is a good point. But again, you're at the mercy of the shareholders, where your economists might say you can only feasibly open up 5 stores this year, but then you've got 200 shareholders screaming for 25 stores. You're gonna want to keep the shareholders happy because they have more money. And so it's it's this tightrope balance of understanding the economics of what you yourself can do, and then keeping the people with the checkbooks open happy.
So I don't know. I think maybe going public is an option, but personally, I think maybe that's an option later on.
I would definitely agree with that. I think they need to get their footing a little more secured into the fast casual segment before they can really, truly consider going public.
Well, one thing that I know we're not supposed to, open up a can of worms, but actually Noodles and Company was referenced in one of my B483 case studies.
B483. That thing
Yeah,
didn't show up on my records.
Yeah, I remember the case from when I took the 483 class as well.
yeah, there was another restaurant called Zoe's Kitchen that was considering an IPO, and they used the Noodles IPO as kind of a reference, a valuation reference.
Hmm.
I mean, I guess they're all options, right? I don't know which one is best. I mean, I guess it depends on the direction you want to take the company, right?
I'd have to go with that. It's going to really depend on how they want to look at their growth model, what markets they want to expand into first, and go from there.
Yeah, I mean, I guess it depends on how fast they really want to grow. I mean, if if their goal is to grow and have that rapid growth, then they need money, right? Or find a way for someone else to finance it because by looking at their self-financing, things seem to go a little bit slower. I mean, I'm not saying it's impossible, but the self-financing and funding each restaurant takes time and lots of work.
Well, does everybody agree that they should, or what does everybody think as far as growth? Should they try to expand as fast as possible to be first in the marketplace, which is one of the things the case discussed? Or, and to do that, they'd really probably need to either franchise or go through an IPO that generates just a ton of cash.
I think a franchising model would be more ideal for them, just because at that point it's the private business individual paying for the license to use their name and their products in the stores. And with the appropriate contracts and the right negotiating, they can maintain a pretty decent degree of control that they'd want over the business itself. Add to that, they also don't have to spend as much money on real estate and equipment, which cuts into their revenues.
Yeah, I kind of agree. I think franchising, I think, would be the better choice for rapid growth. I mean, they're taking away the financial burden themselves, right? Someone else will invest the money to buy the restaurant, the real estate, the equipment, etc., and and that will allow for growth, right? And then you'll have the burden of so many shareholders, right? And creating value for them and having them, hey, we want more money, we want more stores. You can control how many franchises go out. You can slow it down or speed it up, and I think that's probably what I would do.
What would you do as far as the franchisees getting the hiring right? Because one of the things that I was a little worried about with the franchisee would be they had to really kind of peculiar way that they hired, and then when they did the mystery shopper twice a month, and they did a bonus based on that, do you think the franchisees would, go to all that trouble and having four shift managers and stuff? Seems like things like that would really cut into the profit, and the franchisees would tempted to start skipping those steps.
I think that may be part of what would be renegotiated in the franchise or franchising contracts. There's definitely still a way to maintain the caliber of employees they want, whether they come out there to train the initial batch of employees and go from there. But when it comes to the bonuses and stuff, those would probably be held exclusively to the to the Noodles and Company owned locations and differ from the franchise locations.
Could they require the franchisees to do the mystery shopper twice a month, though, to keep the quality up? Consistency?
I think that should be just part of the contract. I mean, if I'm wanting to franchise the restaurants, say, hey, you know what? You're buying the franchise, great, but part of the deal is we're gonna have the mystery shoppers, and and we're gonna make sure it works. And I think there's things you can do to limit the risk, right? Because there is risk, as you mentioned, when you do lots of franchisees with the managers, and who are they going to hire? Are they good? Are they bad? Right? You want to maintain that level of quality, especially with the food and the service. So, no, I think they can build that into the contracts. You have to do it.
Can you guys hear me again?
Yes.
Yeah.
I'm running a hotspot off my cell phone.
Oh, you are just munching through data.
Oh boy, am I. There goes my monthly stipend. Okay.
Well, if Chick-fil-A can require that you only own their one franchise and not very many others, then Noodles and Company can pretty much control your life if you buy a franchise license from them.
Most franchisees that I know of, yeah. If you sign a franchise deal, they own you hook, line, and sinker. You're risking your money on their name. That's basically what it is.
That's right.
So, okay, so I apologize. I don't know what we missed or what we've discussed. Sorry, guys.
Yeah, we were just talking about, the pros and cons of franchising and whether they should growth or not.
Well,
Just leave you guys again.
if their website is any indication, I would say they went with the franchise model.
Well, I can give you their numbers for 2010, 2011, and 2012 if you want.
I'm morbidly curious.
Okay, so they did an IPO, and three months after the IPO, the stock was up 43% from the time that they did the IPO. So it was a huge hit, and it kind of encouraged a lot of other fast casual restaurants to do an IPO based on their success. So here's their numbers in 2012. They had 276 company-owned restaurants, so they're pretty close to that goal of 300. 276 company-owned, 51 franchised. Average unit volume per store was 1.178 million. Same store sales growth was 5.2%. They had restaurant revenues of 297 million, franchise fees of 3 million, total revenue 300 million. adjusted EBITDA percentage was 13.1%, net income 5 million, net income margin 1.7%, cash flows provided by operating 32 million, cash flows by financing 15 million, cash at end of period 581,000.
Oh, so they did pretty well.
Yeah, so they did growth in both ways, company owned and franchised.
The
Yeah, the
food's not
way
even that good.
yeah, the food I haven't been impressed. But what was interesting is what they did right after this case study. They did offer franchises. That was their first step, and they offered them just for a couple of years. And then they let those franchisees remain, but they stopped doing franchises. And they sat on that for a few more years. And I guess the IPO, wasn't that in 2008, 9? Can't remember.
I think
But
2009.
yeah, in 2006, I believe, in my research, 2006 and 7, they started looking at offering franchises again, but they did very limited numbers. And I'm guessing they did that. They decided the IPO was a better approach. So then they released the IPO. So oddly enough, they did a little bit of everything aside from strategic partnerships.
Yeah.
So I don't know that there was any one right answer there. I think they ended up using any and all means possible to achieve what their goals were.
Well, it kind of sounds like they went about it a little bit smarter way, right? Sounds like they did the franchises first, to kind of get their name out there to expand, and then at the right moment, they, had their initial public offering to even get more money, and then by their own continued growth, right?
Yeah.
Sounds like it was plans.
Well, and most IPOs were based on getting venture capitalists paid off. So a lot of investors, a lot of their initial investors would be in support of an IPO just so that they could get their money back out of the investment and move on to other investments.
Yeah.
So I'm wondering if that had a lot to do with their decisions down the road. Is franchising was great, but it wasn't paying back those VCs. And then once they determined the VCs wanted out or whatnot, then the IPO made the most sense.
Do you know what the IPO share price was?
I didn't find that number, no.
Because I know the last valuation that they had and the last funding in the case study was at $31 a share, which was quite a bit more than the 25 cents a share that they started out with. So,
Well, I thought during the reading they had gone as high as 6.5 or 6.25 per share, just for the funding they were seeking prior to franchising.
I'm pretty sure it was $31 the last funding round that they did, where they got like that. I think they got.
Oh yeah, you're right. $31 a share in 2002.
And they got a line of credit for like 25 million and funding of 10 million. Was that what that one was?
Sorry, what was that, Norman?
What? How much did they get in that funding? Was it 10 million?
Yeah, that was 10 million at $31 a share.
And then they also got a line of credit from Bank of America for I think 25 million.
Yeah, I think it was 25 million. I can't find that line right now.
Yeah, so I mean, it sounds like they were, I mean, doing well enough, despite Paul not liking their food. It seemed like investors liked the investment.
So Paul has no taste. Is that what we're getting at?
I don't know.
No, the general public has no taste.
You gotta love it. So, would any one of you specifically have picked one option, or do you think that the multiple options was probably the best approach?
Well, I think
I
it's
do think multiple options was a good approach, and he was actually kind of considering doing it 50-50, half franchise and half company stores.
Yeah, I was gonna say it's hard to say because each industry, each business can be different. Maybe in some cases, a balanced approach might be right. In other cases, maybe it's just franchising, right, or IPOs. So I think it's your business skills and your ability to forecast or what you want to achieve, right, makes a big difference in what approach you take.
Yeah, because even raising 35 million, it costs them about a $500,000 to open a store. So that 35 million would only give them 70 more stores.
Gotta be honest, I would not want to open that many stores. I guess some people have a more expansive view on the world than I do, but
Yeah, look at Starbucks though.
what's that?
Look at Starbucks. They open
Can't
stores like it's
fathom.
like a pepper shaker on a town.
They've got more than McDonald's now, don't they? I think.
Worldwide or in the U.S.?
Worldwide.
Yeah, I don't know.
Yeah, but they're everywhere. So, I guess it just depends on what your strategy is, right, as the business owner, or what you want to achieve, right? If it's be everywhere in every corner in every town all over the world, that's one way to go. Or you can be a little more exclusive, right? Search for the right markets and just be in the markets side. And, it depends.
Yeah, I mean, it all comes down to what you want to, what the company is trying to achieve. So, well, guys, I got to be honest. That's pretty much all they gave us. They didn't give me a whole lot of tie-up, loose end details in the paperwork here. So, anybody have any last bits they want to throw out?
Sorry,
I got
I lost internet connection. I was trying to log back in. Man.
Okay, I found the $20,000 question or answer.
What's that?
Starbucks has 20,000. McDonald's has 36,000.
Oh, God, that's nowhere close.
Yeah.
36,000 locations. I can't even fathom that. I'd settle for $36,000.
That's why when there's an economic downturn, they lose billions of dollars.
Yeah, makes sense.
Yeah. It's just the scale.
Yeah, when you're making 100 billion, what's 1 to 2 billion, right? I mean,
Yeah.
Well, to the investors, shareholders, it's a lot.
All right, guys. Before I milk my data much more, I better call it a night unless anyone has anything else.
All right. Well, sounds good. We'll have to kind of figure out our own little strategies for our write-up.
Yeah. And Norman,
Hey,
you'll
it's
just
not
post
my
a link
data,
like you normally do.
Yeah. I got like knocked off so many times. I hope it just recorded it, not based on my connection.
It always said live even when you were gone, so I'm assuming we're okay.
Yeah, it should be good.
Do you guys know who the group leader is next week?
I was looking for my paper that I had it on there, but I couldn't find it.
I want to
can't remember.
say it's me because I know the week after I'm out of town.
All right. I'll second that motion.
Okay. Paul's got it.
All
All
right.
right. We'll see you guys next week.
All right, have a good night, everybody.
Bye.
See ya.